Welcome everyone, and thank you for joining me today. I'm excited to kick off this presentation on international economics. On this first slide, you'll see the title, Module Overview. We'll be exploring how global finance is shaped by various forces, from currency markets to international trade flows. Specifically, we'll look at the exchange rate and the balance of payments. Over the next few slides, we'll dive into these topics in detail and understand their significance in the world economy. Let's get started. Every day, trillions of dollars worth of currencies are bought and sold across global markets. This massive volume highlights just how vital currency exchange is for the world economy. The exchange rate, which is the price of one currency in terms of another, is a key concept here. It's not set by any single authority, but emerges from this vast, decentralized marketplace. In this marketplace, governments, banks, corporations, and individuals all participate, each with their own motives and strategies. This dynamic environment creates the constantly fluctuating exchange rates we see. Understanding how these rates are formed helps us grasp the larger picture of international trade and financial stability. This is really the foundation of understanding how currencies interact on the global stage. Let's talk about the key point, where the quantity of currency people want to buy matches the amount they want to sell. This is what we call the market clearing exchange rate, or equilibrium rate. It's like the perfect balance point in the currency market. This rate is driven by several forces. On one side, we have imports, domestic investment abroad, and capital flight. These are forces that make people sell their currency. When a country imports goods or invests overseas, they need to exchange their currency for foreign currencies, increasing the supply. Similarly, capital flight involves moving money out of the country, which also adds to the supply of currency. On the other side, the demand for currency comes from exports, foreign investment, tourism, and speculation. When foreigners buy our goods and services or invest here, they need our currency, which increases demand. Tourism also boosts demand because visitors exchange their money for local currency. And speculation, when traders buy or sell currencies hopping to profit from future movements, adds another layer of demand. Like any other market, currency prices are set by the interaction of buyers and sellers. It's this dynamic dance that determines the exchange rate at any given moment. And this is where supply and demand act as the invisible hand of the forex market. They constantly push and pull the currency value towards that equilibrium point, balancing the forces at play. Understanding this interplay helps us see how global economic forces influence currency values and, ultimately, international trade and finance. Market forces are constantly at work, adjusting exchange rates in real time, 24 hours a day, across global trading centers. This means that the rates are always in flux, responding to the latest market conditions. The equilibrium exchange rate is essentially the point where supply and demand for a currency meet. Think of it as the balance point on a seesaw, where the amount of currency buyers want to purchase matches the amount sellers want to sell. When demand for a currency rises, say if a country's exports suddenly surge, that causes the demand curve to shift to the right. As a result, the exchange rate tends to go higher, making that currency more valuable. Conversely, if there's an increase in supply, perhaps due to investors selling off that currency, the rate will fall. This interaction highlights the fundamental principle, where buyers and sellers meet determines the value of a currency at any given moment. It's a dynamic process, constantly reacting to economic activities like trade, investment, and market sentiment. And understanding this helps us see how exchange rates are shaped by real-world forces, connecting directly to the overall theme of how global markets operate and influence economies worldwide. On this slide, we're looking at how various factors can influence the supply and demand for a currency, ultimately shifting its exchange rate. One key point to remember is that traders who bet on future movements can actually amplify currency swings, making the market more volatile. This is what we call speculation, and it can lead to bigger fluctuations than you might expect. Next, we see that uncertainty plays a big role. When there's uncertainty, say, political turmoil or economic instability, it tends to trigger what we call capital flight. Investors pull their money out of the country, which increases the supply of the local currency in the market and puts downward pressure on its value. On the other hand, political stability tends to attract investment. When an economy is stable and strong, investors feel more confident, increasing demand for the local currency. This demand can push the currency's value higher. Economic growth is another factor. When an economy is growing rapidly, it often leads to higher inflation, which can erode the purchasing power of the currency. As a result, demand for that currency might decrease because people want to buy foreign goods or assets instead. Higher inflation makes a currency less attractive, but higher interest rates can have the opposite effect. When interest rates rise, they tend to attract foreign capital, increasing demand for the currency as investors seek better returns. Finally, all these forces, speculation, uncertainty, political stability, economic growth, inflation, and interest rates, act together to shift the supply and demand curves. These shifts determine the new equilibrium exchange rate, showing us how dynamic and interconnected the currency market really is. Beyond just supply and demand, economists have developed more formal theories to help us understand and predict how exchange rates move over time. Two of the most important theories in this area are interest rate parity and purchasing power parity. These theories give us a deeper insight into the factors that influence currency values beyond simple market forces. For example, interest rate parity helps explain how differences in interest rates between countries can affect exchange rates through expectations of future movements. On the other hand, purchasing power parity focuses on price levels and how changes in inflation rates across countries can influence the relative value of their currencies. Together, these theories connect to our broader understanding of international finance by showing us the underlying principles that drive exchange rate fluctuations in a more predictable way. There is no sustainable risk-free profit from currency speculation. This means that, in the long run, you can't consistently make risk-free gains simply by betting on currency movements. The result of this is that capital flows freely across borders until returns are equalized. In other words, money moves where it can earn the same return, regardless of location. This leads to an important implication. Interest rate differentials between countries are offset by expected changes in exchange rates. So, if one country offers a higher interest rate, the currency is expected to depreciate in the future, balancing out potential gains. The core idea here is captured by the formula. 1 plus I domestic equals 1 plus I foreign multiplied by forward rate divided by spot rate. This is known as the no arbitrage formula. What it tells us is that, if interest rate parity, or IRP, holds true, investors should earn the same return whether they invest domestically or abroad. This means there's truly no free lunch in currency markets. IRP essentially states that the interest rate difference between two countries must be offset by the expected change in the exchange rate. If it isn't, risk-free arbitrage profits would be possible, which contradicts the idea of market efficiency. So in this arbitrageur's playground, or the currency market, IRP keeps things in balance. It ensures that any interest rate advantage is neutralized by exchange rate expectations, maintaining a level playing field for investors. Let's talk about how capital flows between countries work until this equilibrium is restored. Essentially, these flows help equalize returns across borders and eliminate arbitrage opportunities. Now imagine a situation where a domestic bank offers a 5% interest rate, while a foreign bank offers just 3%. At first glance, investing domestically seems more attractive because of the higher return. But here, where interest rate parity, or IRP, comes into play, IRP tells us that the expected change in the exchange rate will offset this interest rate differential. So, in this case, the domestic currency is expected to depreciate by about 2%. This depreciation effectively wipes out the apparent gain from the higher interest rate. The key takeaway is that IRP ensures there's no free lunch in international investing. You can't just chase higher returns without considering exchange rate movements. This concept ties into the broader theme of how global capital markets adjust to maintain equilibrium and prevent arbitrage opportunities. PPP, or purchasing power parity, is generally a better guide for understanding long-term exchange rate trends than short-term movements. That's because short-term changes are often influenced by many other factors, like interest rates or political events, which can obscure the underlying trend. When we look at the long run, though, PPP provides a clearer picture of where exchange rates should head. For example, imagine a Big Mac costs $5 in the US and 500 yen in Japan. PPP suggests that the exchange rate should be about 100 yen per dollar, because that's the rate that equalizes the price of the Big Mac across both countries. If the actual exchange rate deviates from that, it signals potential arbitrage opportunities, where traders could buy cheap in one country and sell high in another. This idea is rooted in the law of one price, which states that identical goods should sell for the same price when prices are expressed in a common currency, after adjusting for the exchange rate. So, if the prices aren't aligned, currency values will adjust over time to restore that parity. That's where the Big Mac Index comes in as a practical and accessible way to gauge whether currencies are overvalued or undervalued, based on the price of a Big Mac in different countries. Overall, PPP helps us understand the fundamental forces behind currency movements over the long haul, even though it might not predict short-term fluctuations accurately. While imperfect, this slide really captures the core insight of purchasing power parity, or PPP. Essentially, over time, exchange rates tend to move toward levels that equalize the purchasing power of different currencies across borders. In other words, if a currency is undervalued or overvalued, market forces will push it back toward an equilibrium that balances the cost of goods. One practical way to see this in action is through The Economist's famous Big Mac Index. It's a simple, intuitive application of PPP theory. By comparing the price of a Big Mac in various countries, we can get a quick sense of whether a currency is overvalued or undervalued relative to the US dollar. If a Big Mac costs significantly more in one country than in the US, it suggests that the local currency might be overvalued, and vice versa. So the key question becomes, what should a burger cost? This question helps us understand whether currencies are aligning with the purchasing power of their populations. It's a fun yet insightful way to connect economic theory with real-world prices, reinforcing the broader theme of how exchange rates and prices move together over time. Governments and central banks don't just passively accept whatever rate markets produce. Instead, they actively choose their policy frameworks for managing exchange rates. These frameworks can be fixed, floating, or managed, and each comes with its own set of trade-offs. For example, a fixed exchange rate can promote stability and predictability, which is great for trade and investment. But it might limit a country's monetary independence and could require significant reserves to maintain. On the other hand, a floating rate responds more freely to market forces, allowing for greater flexibility and monetary independence, but it can lead to more volatility. Managed or hybrid systems try to strike a balance between these extremes. Understanding these choices is crucial because they directly impact a country's economic stability, growth prospects, and its ability to respond to external shocks. This ties into the overall theme of how countries navigate the complex world of global finance and currency management. Let's take a closer look at fixed exchange rate systems. On the downside, they sacrifice some of a country's monetary policy independence, meaning the central bank can't freely adjust interest rates to respond to domestic economic conditions. They also require substantial foreign reserves to defend the pegged rate, which can be a significant burden. Additionally, these systems can make a country vulnerable to speculative attacks, where investors might bet against the peg, forcing costly interventions. However, there are notable advantages. Fixed exchange rates can reduce exchange rate uncertainty, which is beneficial for trade and cross-border investments. When businesses know the exact exchange rate, it helps stabilize planning and reduces risk. For example, the Hong Kong dollar is pegged to the US dollar, providing stability. Historically, the Bretton Woods system also exemplifies this approach, where countries fix their currencies to the US dollar. In essence, fixed exchange rate systems are about achieving stability at a cost. They require commitment and resources, but can promote economic predictability. This approach ties into the broader theme of how countries choose different mechanisms to manage their currencies and economic stability. Maintaining a fixed exchange rate is no simple task. It requires constant vigilance. Authorities need to be ready at all times to deploy foreign reserves when needed, and to adjust monetary policy to help defend the peg. This is a delicate balancing act because if market pressure remains sustained, or if there are speculative attacks, it can easily overwhelm these efforts. It's like walking a tightrope. Any misstep can lead to a loss of the fixed rate. Throughout this presentation, we've seen how crucial it is for countries to carefully manage these mechanisms to maintain economic stability. So let's look at some examples like the US dollar, the euro, and the Japanese yen. These currencies are all determined by global market forces, meaning their values fluctuate based on international economic activity and investor sentiment. Because of this, floating exchange rate systems can produce significant volatility and uncertainty. This means currency values can change rapidly, which can be risky for businesses and investors. Additionally, they're susceptible to speculative bubbles, where currency prices might become inflated beyond their true value, leading to potential economic instability. Now, on the flip side, a key advantage of floating exchange rates is that they allow for fully independent monetary policy. Countries can set their interest rates or implement monetary measures without needing to maintain a fixed currency value. This flexibility acts as an automatic stabilizer for the economy by helping absorb external shocks, like sudden changes in global markets or economic crises elsewhere. So, in summary, while floating exchange rate systems can introduce some volatility and risk, they also offer significant benefits in terms of economic autonomy and stability during external shocks. This balance is a crucial part of understanding how markets and currencies interact in a globalized economy. Most countries today operate what's called a managed float, or sometimes a dirty float. This means that, under normal conditions, the market determines the exchange rate based on supply and demand. However, the central bank keeps a close eye on the currency and steps in when things get too volatile. If the currency starts to fluctuate wildly, and that volatility could cause economic problems, the central bank may buy or sell currencies to stabilize the market. This approach strikes a balance between complete flexibility and rigid control. It's about giving the currency some room to move naturally, but also having the tools to intervene when necessary to maintain stability. You can think of it as the middle ground, where market forces set the baseline rate, but the central bank can intervene to smooth out excessive swings. This way, countries avoid the extremes of a pure float, which can be unpredictable, or a fixed peg, which can be too rigid and hard to maintain. So, in essence, the managed float allows for a flexible yet controlled approach, helping to keep the currency stable while still respecting market dynamics. Now, beyond just looking at exchange rates, economists also keep track of something called the balance of payments. This is essentially a comprehensive record of every single economic transaction that happens between a country's residents and the rest of the world. It includes things like exports, imports, investments, and financial transfers. The idea is that it shows us how a nation earns its money from the global economy and how it spends or invests that money abroad. By analyzing this record, we can get a clearer picture of a country's economic health and its relationships on the world stage. Understanding the balance of payments helps us see beyond the surface of exchange rates and get to the bigger picture of a country's economic interactions worldwide. By construction, total credits must equal total debits. The balance of payments always sums to zero. This is a fundamental principle that keeps the system balanced. Every transaction generates both a credit and a debit entry, mirroring standard accounting practice. This double entry system ensures that all economic activities between a country's residents and the rest of the world are accurately recorded. It captures the full scope of international economic transactions over a specific period, providing a comprehensive record. So, when we talk about the balance of payments, or BOP, we're referring to this complete picture of a country's economic exchanges with the world. A persistent current account deficit signals that a country is living beyond its means internationally. Essentially, it means the country is spending more on foreign goods, services, and income payments than it is earning from its exports. The current account is the broadest measure of a country's international trade position. It includes not just trade in goods and services, but also income flows and transfers. When a country has a surplus, it earns more from abroad than it spends, meaning it's a net lender to the rest of the world. Conversely, a deficit indicates the country is a net borrower, importing more than it exports plus income and transfers received. Understanding the current account helps us see the bigger picture of a nation's economic interactions with the world. It reflects whether a country is accumulating assets or liabilities over time. In summary, when we interpret the current account, we look at the trade and income flows. A surplus suggests a position of strength, while a deficit can point to vulnerabilities if it persists over time. Recognizing these patterns is key to understanding a country's economic health within the global economy. When a country consistently imports more goods and services than it exports, and at the same time receives less income from abroad than it pays out, this situation is called a current account deficit. Essentially, it means the country is spending more on foreign goods, services, and income payments than it is earning from its exports and foreign income sources. This creates a gap that needs to be filled somehow. The country has a few options. It can attract foreign capital, which might come in the form of investments or loans. It can borrow money from abroad, or it can use up its reserves, which are the savings it has built up over time. This concept ties into the overall theme of how countries manage their economic relationships with the rest of the world. A current account deficit isn't necessarily bad. Sometimes it's a sign of strong investment and growth prospects, but it does mean the country is relying on external sources to finance its spending. Now let's take a closer look at some of the key types of investment flows. First, we have loans, currency deposits, and trade credit. These are essentially short-term or medium-term financial arrangements where funds move between countries, often to facilitate trade or meet temporary funding needs. Next, we come to other investments, which include investments in stocks, bonds, and other financial instruments. These are more about portfolio investments, placing funds in various financial assets to generate returns rather than controlling physical assets. Speaking of portfolio investments, these involve long-term holdings in physical assets like factories, subsidiaries, or real estate. They tend to reflect a country's confidence in the long-term prospects of those assets. Then we have foreign direct investment, or FDI. This is a specific type of investment where a company or individual takes a significant stake in a business or physical asset in another country, often involving management control. It's a major indicator of economic integration and commitment. Moving on to the financial account, this records transfers of ownership of fixed assets and debt forgiveness. It's generally relatively small within most countries, but still an important part of understanding overall capital flows. Finally, the capital account mainly tracks capital transfers and the acquisition or disposal of non-produced, non-financial assets. All these components together, covering loans, investments, and transfers, compose the overall capital and financial accounts. They help us see how countries finance their deficits or invest abroad, which is vital for understanding the global economic landscape and the interconnectedness of economies. When domestic investment exceeds savings, it means that the country is investing more than it is saving internally. In this case, foreign capital has to step in to fill that gap, which is reflected in a financial account surplus. Essentially, the country is borrowing or attracting investment from abroad to fund its investments. Now, a low savings rate plays a significant role here. When savings are low, it makes exports more expensive and imports cheaper. This imbalance widens the trade gap because consumers and businesses are more inclined to buy cheaper foreign goods rather than domestic ones. Additionally, high inflation or an overvalued currency can exacerbate this situation. When inflation is high or the currency is overvalued, imported goods become more attractive because they are cheaper, leading to increased imports and a trade deficit. Strong domestic demand is another key factor. When there's persistent demand for goods and services within the country, it often results in a current account deficit. This situation is usually driven by a mix of domestic factors, like consumer preferences and structural issues within the economy. Putting it all together, a persistent current account deficit is often the result of a combination of these factors: low savings, high inflation or an overvalued currency, and strong domestic demand, all of which influence the flow of international capital and trade balances. The balance of payments, or BOP, always balances, but the real story is in its composition. What this means is that if one part of the BOP shows a deficit, another part will show a surplus. For example, if a country runs a current account deficit, it's usually offset by a surplus in the financial account. That surplus indicates that foreigners are investing in that country, financing the shortfall. It's important to remember that the sum of the current account, the capital account, the financial account, and net errors and omissions always equals zero. This is what we call the fundamental identity of the BOP. Let's break down the key components. The current account covers trade, income, and transfers, things like exports and imports, earnings from investments, and remittances. The financial account deals with portfolio and direct investments, so foreign investors buying assets or establishing businesses here. The capital account includes capital transfers and asset transactions, like debt forgiveness or transfers of ownership. And then there are the net errors and omissions, which account for statistical discrepancies that happen in the data. All these parts work together to ensure the overall balance is zero. If there's a deficit in one area, it's balanced by a surplus somewhere else. This balancing act is what we call the BOP identity. It's the accounting framework that keeps everything in check. So, in essence, the BOP is a comprehensive picture of a country's international financial position, showing how trade, investment, and transfers all interconnect. It's a fundamental concept that helps us understand the flow of funds across borders and the overall financial health of a nation. When we look at small, open economies, they often find it beneficial to adopt fixed or managed exchange rate arrangements. These setups can provide stability and help foster confidence among traders and investors. On the other hand, larger and more diverse economies tend to have the capacity to absorb the volatility that comes with a pure float. Because their markets are bigger and more varied, they can handle fluctuations without significant disruptions. Most countries today don't stick solely to one approach. Instead, they operate some form of managed float, which allows them to respond flexibly to changing economic conditions. This highlights an important point. There's no one-size-fits-all answer when it comes to choosing an exchange rate policy. The optimal choice really depends on a country's specific circumstances, like its size, how open it is to trade, its inflation history, and the credibility of its institutions. So, when we're talking about choosing the right regime, it's all about understanding these factors and how they align with a country's economic goals. Comparing different exchange rate regimes helps us see which might be most appropriate for a given context. It's a nuanced decision, tailored to each country's unique situation, and central to managing economic stability in an interconnected global economy. Both theories agree on a key principle. Exchange rates are not random. They actually reflect fundamental economic relationships that tend to reveal themselves over time. Let's focus first on goods markets and inflation differentials. The main idea here is that trade flows work to equalize goods prices across different countries. Over the long run, this process helps keep exchange rates aligned with relative price levels. Now, turning to financial markets and arbitrage, the focus shifts to capital flows. These flows help to equalize investment returns across countries. Essentially, when returns differ, capital moves to where it's more profitable, which influences exchange rates in the short to medium term. This brings us to the core distinction between purchasing power parity, or PPP, and interest rate parity, or IRP. PPP primarily concerns the goods market and inflation differentials, with a long-term focus. It suggests that exchange rates will adjust to reflect changes in price levels over time. In contrast, IRP is about financial markets and arbitrage opportunities. It deals with capital flows and investment returns, typically influencing exchange rates over shorter time horizons. Understanding these key differences helps us see how exchange rates are driven by both real economic fundamentals and financial market dynamics, aligning with the overall theme that exchange rates reflect underlying economic relationships over time. Every current account deficit is mirrored by capital inflows, and understanding the composition of these inflows is what truly matters. It's important to recognize that the balance of payments always balances overall. Whether a country is under fixed, floating, or managed float exchange rate regimes, each approach comes with its own distinct benefits and vulnerabilities. Policy choices in managing exchange rates involve real trade-offs, and the theories we use help us understand these. For example, interest differentials and price levels play a key role in constraining how exchange rates move over time. Interest rate parity and purchasing power parity are fundamental concepts that anchor market expectations. They are set by supply and demand in the foreign exchange market, but are also influenced by factors such as interest rates, inflation, economic growth, and market sentiment. Finally, it's essential to remember that exchange rates are essentially market prices. They reflect the collective behavior of numerous factors and expectations. Understanding these points helps us grasp the complex dynamics of international financial flows and currency movements, which are central to the overall economic picture. Mastering these concepts is absolutely essential for anyone who wants to navigate the complexities of international markets effectively. Exchange rates and the balance of payments are not just abstract ideas. They are the vital signs of a nation's economic health. They tell us how well a country is doing economically and how it fits into the global system. For policymakers, understanding these concepts helps guide important decisions about monetary policy and trade strategies. For businesses, they influence how companies set prices and make investment choices across borders. And for investors, these factors are key to understanding real returns when investing internationally. In conclusion, the interconnectedness of our world economy means that these concepts are more relevant than ever. They remind us that what happens in one country can ripple across the globe, affecting economies everywhere. So, mastering these ideas isn't just academic, it's crucial for making informed decisions in today's interconnected world.